We couldn't do an event like this without our great sponsors, as I mentioned before. And tonight we are really thrilled to welcome Baird Financial as one of our VIP sponsors. So really thrilled to have them. And I'm really excited to bring to the stage Gordon Pan, who is the president of Baird Capital, and GeekWire chairman Jonathan Sposato, who are going to share some insights on the economy. Thanks for being here.
Hey, thanks so much, everybody. Hey, you know what? Baird Capital is the kind of firm that I wish that I knew more about when I was starting out as an entrepreneur, as a CEO, trying to raise money. They are what I call a full spectrum, full life cycle firm in the sense that they do venture capital investing, they do private equity and growth equity investing, and should you be lucky enough to have an exit as an individual, they also can take care of private wealth management. And so Gordon Pan here, we're so honored to have him come all the way from Chicago, from his head office, to visit us in Seattle. He, as the president of Baird Capital, is responsible organizationally and strategically for the venture side of things, the private equity and growth side of things, and the private wealth management side of things. So let's give it up for Gordon. Everybody, Gordon Pan, yeah. And I have to say, Gordon's the kind of guy that my Chinese mother would say, Jonathan, why can't you be more like Gordon? Why can't you be more like him? So let's have a seat and we'll chat a little bit. I know that there's a lot of amazing entrepreneurs, CEOs, operators, co-founders in the room. And Gordon's here to enlighten us on some things that he's seeing in the marketplace, some important things that we all want to know more about. Isn't that right, Gordon?
Yes. Yes.
Yeah. Great. Okay, so I know a lot of CEOs and founders out there, what they want to know is what are some key attributes that a top firm like Baird Capital looks for when they think about investing in a new company? What are the things that are the most important to you, Gordon?
Yeah, first off, Jonathan, I appreciate that introduction, and I think my mom would actually rather have you than me.
You're too kind.
First off, thanks a lot for having me here. I really appreciate the opportunity to make a couple of comments. This is an amazing event. I think we should transition this over to Chicago as well. I think this would port over to Chicago.
GeekWire Chicago style. Yeah.
In terms of investing, I have to say, the fundamentals of investing haven't changed, right? It's just you want to back strong, proven management teams. You want to look at industries that are growing, that have really good trends. And you want to invest in companies that have a product or a service that is highly differentiated, right? And if you have a company that has those things, show up in the financial results of your business, right?
No, actually, well, some of these questions overlap, so this is good. When I was starting out, I remember the hash marks were always, you get to a certain point, you can do your seed, your Series A, and you can't even contemplate going public until you have 50 to 55 million in annual recurring revenues. So what are these hash marks now? What do operators, CEOs out there growing their companies, what are the important milestones that they need to think about?
Yeah, I think it's a very important question. I think the environment has completely changed, right? In a zero-rate environment, cash is basically free, right? And so it was all about growth at all costs. Today, the environment has completely changed. Now it is all about growing, but in a disciplined manner, right? So it's about capital efficiency. And so I'll tell you, I think now a lot of firms are more focused on very specific fundamental financial metrics, right? So I'm going to give 3 metrics that we focus on that I hopefully will be helpful to everybody here. First, we focus on growth rate, right? So if you're going to be a Series A, B, or C company, you want to be growing at least 50 to 100%. If you're not growing 100% in an early stage company, you're not going to get a lot of looks from a venture capital firm. I think the second one is net revenue retention, right? Net revenue retention focuses on the durability of your revenue model. So if you want to entice venture capital firms, you want to show at least 100%. If you bring in 90% of net revenue retention, we probably wouldn't look at you. But if you have 115%, that's exceptional performance, and we will be all over you, right? So that is another important metric. The other metric is the Rule of 40. I think many people here know the Rule of 40, right? That measures capital efficiency. Today, it is about capital efficiency. How do you grow, but in a prudent way? So we want to see businesses that grow between their growth rate and their margin rate, that it's at least 40%. If you have those 3 things, you have a very attractive business model, right? If you have an attractive business model, people are going to be interested in talking to you. Then it's going to be up to you to find the right partner, right? Make sure you find a partner that can deliver the value add that you want. Importantly today, the market is changing. Every firm is specializing. So every firm is coming up with their value proposition that allows them to deliver value to you as a management team. Make sure you find the one firm or two firms that can help you the most. Because capital is a commodity for attractive companies. Just remember that. You build the fundamental value in your business, then go find the right partner, and then the right partner will help you build the business to the next level, which is to hopefully take it to public.
That's great, Gordon. Really appreciated those very important data points. So I know I've internalized them and thinking about them on the next company. So I guess we'll kind of zoom out for a bit. I know the question, the $1 million question that everybody's interested in knowing is that with the understanding that the current fundraising environment is difficult and challenging, certainly for people who are out there trying to raise, and maybe they're not quite meeting some of the numbers that you just discussed, the percentages. Where do you think, first of all, level set us on where we're at today and where do you think it's going, and perhaps some predictive thoughts about when it might get better?
Yeah, I think this is a very important question. I think everybody in the audience is thinking about this, and I'll share my perspective. There is a lot of capital out there today, a lot of capital. I'm going to give a little perspective. There's $300 billion of dry powder in the venture capital industry today, $300 billion. There's $1 trillion private equity dry powder today in the market. It's all looking to be deployed. The problem is that the buyer-seller expectations have not converged yet. The valuations are still just not level set, right? If you're a buyer today, relative to the last several years, you're seeing higher interest rates, right? You're seeing slower growth, geopolitical risk, an impending national election. All these things dampen down valuations from a buyer's perspective. The problem is on the seller side, the people raising money, they have yet to fully capitulate to this idea that the valuations that were done over the last several years are still valid today, right? People are waiting to see if they can get that same valuation. The problem is that only really the exceptional companies with all the metrics I mentioned recently, and also operating in great markets like AI, right? They may warrant some of those valuations, but the vast majority of companies today are not going to get the valuations that we saw over the last several years. So until that happens, until this capitulation happens, the market's not going to fully unlock, right? The good news is it's starting to unlock. We are seeing this. Our firm predicted it was going to happen at the end of last year. It didn't happen. We thought it was going to happen in the first half of this year. It's starting to happen, right? And why? It's because buyers are realizing we have a lot of money, we got to spend it. Sellers are people who are raising capital, they're realizing we need to raise the capital to drive our business model. So it's starting to happen. The good news is I think that momentum is going to continue. So our prediction, this is my prediction, and our internal team plans is that the back half of 2024 into 2025 are going to be very, very strong investment in M&A markets. So my words of encouragement to all the entrepreneurs out there, focus on getting your fundamentals right, because I think the market's coming your way.
All right, and with that, Gordon Pan, excellent. Let's give a big round of applause for Gordon.